If you're someone who struggles with keeping track of the balance in multiple accounts, I have an easy solution for you. Get the Jupiter Digital Banking app. You can connect multiple accounts on Jupiter Money and view all of it in one place with their new net worth feature. They also have another fantastic feature called Debt Tracker, which helps you track all of your loans on Jupiter and also sends you reminders for loan payments. It's quite simple, a banking app that helps you master your money. Check jupiter.money to find out more or download the Jupiter app on your Android or iOS phone and get started. Folks, welcome to Paisa Vaisa. I'm your host Anupam Gupta, B50 on Twitter, and on today's episode, I'm really thrilled, excited to have one of the most familiar faces in the markets, veteran in the markets and in trend investing, Atul Suri of Marathon Trends. We're going to talk about trends, how they play a major role in investing, what Atul feels of the longer term theme going on in the markets, and much more right after this short break.
Don't you think that if everyone around you is getting smart, you better be smarter? Hey there, I'm the traveling professor Siddharth Deshmukh and I'm back with season 2 of my podcast to make you smarter. Smarter with Sid. What's this season's focus about? Well, it's about 10-minute nuggets that will make you stand out at work. It's time to go from smart to smarter. Tune in every Tuesday and Thursday and become smarter with Sid.
And welcome back. Atul, welcome to Paisa Vaisa. Thank you so much. Yeah. Thank you so much for coming over to the studio and doing this for our listeners. Yeah. Tell us, let's start with something about marathon trends, about yourself. This is rich experience that you have in the markets. You started like in the 90s, Australia, rare and everything. Tell us about that. Let's start from there.
So, pretty much a vintage guy in the market. You know, I came in the market in 1990. 1990 was a very important year because it was the Harshad Mehta bull market. And this was that point when, you know, the first generation of professionals came in the market. Prior to that, stock market was that one Dalal Street, mom and pop shop, ancestral stuff. And I was doing my CA. So my father was really disillusioned that, hey, you know, instead of practicing as a chartered accountant, you decide to get into something called Satta Bazaar. That was the term then. And that was the image. But, you know, I thank Harshad for bringing the stock market from page 13 to page 1. Yeah. You know, and I kind of found a very good mentor early in Parag Parekh. So Parag Bhai was the first guy I joined. I joined in equity dealing, in research actually, then went on to dealing. And he was a very, very, good role model to have. I remember that thanks to Harshad Mehta, I made some quick money. And he told me that, son, with this whatever lakh or two that you have, rather than buying the next stock, I would invest it in education.
Wow.
And that helped me to pay my fee for the first 2 semesters. And you won't believe, Anupam, I paid my fees and 15 days later the market crashed. So if I had put that money back in stocks, it would have all been zero. And probably not a education or exposure that I had after that. Went to Australia, did a master's in international banking. Could have stayed back, could have gone to Singapore, but the passion of markets, just the joy of looking at the future, just the joy of how the world is changing was so overpowering. Came back to India, stock market back again, started with Birla Sun Life in broking. Then a few years later, found another mentor, another big influence in Rakesh Jhunjhunwala. And in this whole journey, I also, apart from the fundamental background, discovered the joy of technicals, understood the importance of respecting the market, especially in the 2000, in the whole Ketan Parekh or the IT crash. Just realize how important the discipline is. And then subsequently joined Rakesh ji at Rare Enterprises. Have worked with him for 10 years exclusively, managing money, advising him. That was a very rich experience, and that really brought the big shift. The shift from more of a trading mindset to more investing and compounding. And in 2017, started my own PMS with his blessings. Marathon Trends, still connected, advising Rare, wonderful mentors, great people to be with. And as I said, what has changed for me? From one single client, I have a few hundred. Wow. That's all the shift that there is. But it's a nice shift. And markets challenge.
Look at that. I mean, just look at that. I mean, you're talking about Harshad Mehta, and we all remember those times. I was there in college at that point of time. You're talking about Parag Parekh, one of the legends.
Absolutely.
People are looking at his FlexiCap fund now, but anybody who goes back knows how legendary he was. Yeah. And of course, you're talking about Rakesh Jhunjhunwala himself. What great training. I mean, I like this. I'll tell you why. Because we keep on hearing Warren Buffett and Peter Lynch and X and Y and Z. But bhai, India bhi to dekho yaar kabhi.
India zaruri hai. And another thing I pride myself, I'm happy about myself, as I tell Ask people, how many bear markets have you seen?
Oh, okay.
How many bear, like a lot of kids come in and they come and give you all that stuff. And I said, how many bear markets have you seen? So at least my claim to fame is I've seen 4 bear markets and survived. In the end, the whole game is about survival, man.
Indeed.
This whole compounding thing, it's great. It's great picking great stocks, etc. But the big thing is to be able to survive, because survival itself brings in the power of compounding.
What a point to make. And we've seen the Sensex when it was at Nifty, at 3,000. So we've seen Sensex when it was almost at Nifty levels. But let's start with trend investing, right? Because that's what Marathon is about.
Sure.
What is trend investing and how does it, probably fit in with the other schools?
So trend investing, again, there's no hard and fast definition. Let me just share what I think about it. Over these 30 years, as I said, I've been fortunate to see these great investors. And I realized that, market does what it has to, 13, 14, 15% compounded at an index level. But hey, there are these guys who've gone out and created billions and hundreds and thousands of crores. How do they do that? Definitely not at compounding 14, 15%. They've done something better than that. Yeah, so you've encountered them and then you wonder, what is it? How did they get it right? It's not that they're making more money, and people think that, these guys are great. They get the top, they buy at the bottom, they operate the market, they control the market. I think that's all humbug. Those days are gone. There are too many players. But one thing I realized is all these people were very good at picking up the larger trends. What they did was that whenever the market changed its trend, they were able to align with it. And they got into it in a bit of a, I would say, concentrated way. And that's when the trend played out. The kind of compounding they had was tremendous. I'll give you an example. I said 1990 came in the market. The biggest index run in our life I have seen and will ever see, I think, was a 600% return thanks to the Harshad Mehta bull market.
Yep.
You're talking about 3,000, the index was 600. 6 or 36.
6 or 36. That was the Harshad Mehta effect.
That was the Harshad. That was the biggest index bull run we ever see and will ever see.
In the shortest period of time.
In the shorter period of time.
Nothing has come close.
Nothing. And the beauty is that, this was great. But if you had just bought a cement stock.
Oh.
What cement stocks did. Same thing happened in 99-2000, IT bull market. Index doubled actually. But even if you went and picked up the most obvious stock that time was also Infosys. Infosys up a few %. Yeah. I'm not talking about Wipro and etc. But that are the kind of returns. 2003, 2008, big bull market. But infra stocks, or the real estate stocks. So I realized that, hey, these guys had the ability to align with the bigger move, the bigger trend, the bigger theme. And that is what I try to do, is ultimately catch the bigger theme and be able to align with that. Once I'm able to move my portfolio or investors' money between these themes, I feel that's where the alpha can be generated. So that's how I view trend investing, as nothing being aligned with the theme. And the beauty is that the theme changes every bull market. No theme is consistent.
So let's talk about the process here, Atul, because I'm sure that even you would know that this is not easy.
Yeah.
Right? Because cement in the 90s, tech in the 2000s, and real estate in 2003 to 2008, or I guess banks probably post 2014.
Absolutely.
All of these. Being there at the right place at the right time is something that requires a process. You don't just flip a coin and
definitely not.
Let's talk about the process.
So I am a person who combines two disciplines. In our market, people are fundamentals, investors, technical traders. So that's it. That's how people define them. They are two separate pockets. But I was fortunate. I started as a fundamental analyst. I took on technicals in Australia out of passion. And I kind of combine both of them. And I think they're very, very important. Because first and foremost is that I look for trending earnings. Trending earnings is that I have learned over time that, yes, there may be, it's ultimately earnings that drive stock prices. A lot of stock prices move without earnings, but it always ends badly. So if you're managing money for others, remember you're a custodian of others' wealth, you don't want to be in those places. So the first and foremost, the driver, the engine of markets is actually earnings. So what I look for is trending earnings, which is the fundamental side, but it has to be appreciated by the market. And that is what I call trending prices. So it's a combination of trending earnings and trending prices. And that is where the whole interplay of the word trend investing comes in. So what I really do is I try to look for companies that are, sort of seeing longer term growth trends in earnings, plus an acceleration in the short term. I've noticed that it's like IT we're talking about. you'll notice that IT stocks may have done well in 99, 2000, but it's not that they were only doing well. They were actually, the earnings were accelerating very, very beautifully well before that. Later on, the market recognized it. And that is what got built into the price. And we had that Y2K kind of situation at that stage.
Yeah.
That was the buzzword. And then we went into eyeballs and, et cetera, many things. That is the market recognition. So really, you have to have a mix of both. You have to have a mix of both. It was like, let's say, the real estate boom. It was all, yes, real estate stocks were great, etc. But then the whole land bank theme happened.
Yeah.
And that's when the cocktail mix was happening. The kind of rally that you saw in those kind of stocks, of course, we don't like to talk about Unitech right now.
Oh, of course.
How many 20 circuits or something on the upside?
Absolutely.
Jacob, one of the biggest wealth creators in the world. I remember.
Yeah.
I was reading an international magazine and they were listing out which is the biggest wealth creating stock in the world. And voila, up there was Jacob. Indian stock.
Yeah, and we've not even heard of it till then.
Yeah.
If you're talking real estate, you would have had the bigger names at that point of time.
So this is really the need to respect markets also. So I kind of understand that. And what I do is I have a combined strategy of trending earnings and trending prices. And the most important thing, the most difficult thing, and which is very obvious, is a very cliched line: cut your losses, ride your winners. Everyone knows about it, but I think it's very, very difficult to do. Cut your losses is very important because, in this market, when trends play out, when trends end, most people are unable to exit.
Yeah.
The problem is that is the most difficult time. It's your ability to cut and then move on to the next trend. The market, I told you about the cement bull market, right, in 90. In the next bull market, which was a 2000 bull market, IT did well, but cement underperformed. In the next bull market, infra did well, but IT didn't do well. In the next bull market, banks did well, but infra didn't do well.
Yeah.
And now if you see the next bull market post that, you'll find that banks, however popular they are relatively underperforming.
Yeah.
So the people get lumped with leaders of the last bull market, but the market's moved on. A new trend has started. And that ability to churn and move on from trend A to trend B is what trend investing is all about.
Let's get a little bit deeper into stocks, Atul. Two of them that I know that you like, there's Titan and there's Deepak Nitrite.
Yeah.
Played beautifully.
Yeah.
The trend investing theme. Let's just talk about that for a while.
So let me take you to another stock.
Sure.
Titan I wouldn't like to because it's of course Rakeshji's glory.
Yeah.
I'll leave it to him.
Fair point.
He discovered it. But I think for me, in that phase also is a stock called Eicher Motors.
Of course.
I remember that stock was something that for me, that was the first big reinforcement of my belief, a demonstration of what I did. And that's what happened, I remember the Royal Enfield motorbike, waiting 3 months, 6 months, 9 months, whatever that there was, prices were going up. And Eicher for whatever, the interesting part was most people wouldn't wonder, what Eicher, they didn't know they were Volvo buses, ye two-wheeler, दूध वाले का motorcycle. There were a lot of myths around that whole bullet bike and all that.
This you're talking about the early phases, right?
And there was a lot of mental this thing. But hey, the earnings were doing something else. And the price was doing something else. And you got a sense that here was a trend. Every quarter on quarter, I remember, Anup, it would beat expectations. And the price would just move on. Those markets were not spectacular, but this stock went on its own pace, at its own run. So what we saw was a case of trending earnings in spite of all the perceptions that people had, which were negative.
Yeah.
However, it was later that people realized, you had a new young kid. He had changed the bike.
Lal,
it was, technologically very different from what, ancestrally what people remember a bullet bike. Yeah. And then it became a status symbol. Yeah. And that's when the waiting started. But the beauty is that whole thing was reflected in price. Quarter on quarter beat. And the prices just trended. So when markets used to correct, Eicher used to hardly correct. And the moment the market stabilized, it would go on to make new highs. So for me, Eicher was like a 6-bagger or 7-bagger or something. And remember, those years were not very spectacular in terms of indexes and things like that. They were pretty much, middling kind of years. So for me, the first experience of this was actually Eicher Motors. The second was Deepak Nitrite, or actually the whole specialty chemical theme. In fact, more than Deepak, I think I made more money in SRF. And
Let's actually talk about that, because there was a lot of disbelief in specialty.
Yeah.
Remember, the early days when specialty chemicals started, there was so much disbelief that it's low P because it's supposed to be low P.
Absolutely.
Isme ye problem hai, usme wo problem hai, don't believe the annual reports, don't believe the numbers, etc.
Absolutely.
I don't know what happened after that. In the next 3-5 years, it was the next big thing. And people, you're right, people who got into that, let's talk about that. Yeah.
So essentially, the theme of specialty chemicals was playing out for very long. Again, hardly covered, lot of myths, lot of disbelief. And, like there's another company, Atul Limited, of course, namesake. But the fact is, you go out and look how these stocks have compounded for 4 to 5 years. In fact, the biggest wealth creators pre-COVID, post-COVID has actually been specialty chemicals, because you had pockets, you had some stocks that the banks did well, in a pre-COVID kind of phase. Post-COVID, they really didn't do much, but you find that these stocks actually have continued to perform post that. So these were, again, as I said, the sector should be under-researched. Hardly any analysts covered these. They were all small cap kind of plays, so nobody wanted to even touch them. They were paria stocks, non-institutional stocks, under-owned. It was hardly a part of anyone's portfolio. Hardly did anyone have even 1% exposure to specialty chemicals, and little understood. Because honestly, it's like a very complex industry, all these chemicals, names, etc. So here you had an under-owned, under-loved, under-researched things, but hey, it was giving out very good numbers. There was disbelief. And it took very many years to accept it. For me, the moment of reckoning came was when the COVID fall happened. So one thing I look for, Anupam, is that when markets correct, I like to look at stocks that fall less. Stocks that fall less in falling markets are leaders of the next bull market.
They're telling you something. The price movement is telling you something.
Absolutely.
Wow, okay.
And when COVID happened or hit, I realized that as a bunch, I was looking at specialty chemicals before that. I mean, I had like fair weightage to them, but I went hugely overweight at COVID or around, whatever I exited in financials. I think that I moved towards specialty chemicals. And that was something which I found earnings were intact. Pre-COVID, post-COVID, the prices were falling less than the broader market, which is again for me a very good signal point of view. And they were the early stocks to break out to lifetime highs.
Anything?
So that's what specialty chemicals is about.
So, okay, Atul, before we go into the break, let's talk about the tricky part.
Sure.
And you touched upon that when you were talking about trends. That's getting off the bus.
Absolutely.
Knowing when that change is happening and being positioned then also. Because like you said, if you were in cement in the 90s and if you didn't get off the bus at that time, your portfolio would have paid the price. Same for IT, and you said it yourself, because these leaders ultimately become laggards.
Yeah.
And if you still have that conviction and if the earnings is still giving you some kind of signal,
absolutely,
how do you get off the bus here?
So here, Anupam, the problem is not knowing. The problem is doing. It's the emotion comes in. I find that the whole quantitative work or technical work I do, the beauty about that is that there's no subjectivity. Let's take a simple thing. We all know what a 200-day DMA is, right? Let's assuming I make a principle that if the stock breaks below the 200 DMA, I sell. Okay, not that I do it, but I'm just giving an example. The answer is definite. It's binary. Either the stock is above, which I am holding. If it goes below, I know it's gone below. It's a binary. It's a sell. So the first and foremost is clarity of thought. This process gives you immense clarity of thought. What should be my position today, I know. It's not if, but, aadha position kar lo, quarter, average down, doubled up, all those kind of things. It doesn't have any subjectivity. It's clarity. And you need clarity, especially while selling. Because at that stage, your mind, as it is going through a lot of angst, through a lot of pain, doubt, self-doubt. And you always want your stocks that you're holding to continue. You hate selling them. And more importantly, if you have to ever book a loss. So what happens is that I find that the challenge is not intellectual. The challenge is emotional. And that ability to sell is something which I have learned through the hard way. That, I have seen, especially in the IT time, I've seen stocks like, I didn't sell it and then the stock hits downside circuits. We used to have, 8 and 16% circuits for the next 3 days and the stock, it just halved. So I realized, I learned my lessons. So as I said, I may miss a buying opportunity, but when I have to sell, I would never miss that, because that is something that will keep me alive, will keep me afloat. And that, as I started my interview with, is intrinsic to compounding, survival. And for your survival, you should be able to cut your losses. So I think that is a discipline that is there. It is more emotion than intellectual.
It's interesting that you said that because emotionally it's a bit gut-wrenching. I remember I've spoken to so many people, and one stock that has kept on coming again and again for the last, I don't know, 5-10 years is Bajaj Finance.
Yeah.
आज तक जिसने उसको बेचा है
Yeah.
सब रिग्रेट में ही रहे हैं.
Including me at one point in time.
That's very candid. That's very honest of you to
It's
to
okay.
accept that,
It's okay.
man.
It's okay.
So
man.
how does that whole cutting your losses
Yeah.
and holding on to the winners, you can never know what's the difference ultimately in the long run if you're proved not, because the way that our brains are functioned, you call it
Right.
loss aversion, you call it
Right,
whatever.
Right.
Regret is so powerful. How do you handle that emotion? It's
See,
just-
Anupam, also, at one stage I loved a stock called Suzlon.
Okay.
In 2008, I thought like it was the best thing after sliced bread, simply because
Wind
really-
energy is the next.
Absolutely. Till today, alternative energy is the best theme. So the theme was not wrong.
Yeah.
It's 10,
Bal-
12 years.
Balance sheet looked damn good.
It was superb.
Yeah.
You had a great promoter. In fact, one day he overtook, I remember, even Mr. Ambani.
Yeah.
Became the richest Indian. Everything was right. All
His-
the brokers were running after him.
His plans were fantastic.
Absolutely.
Yeah.
So I thought like here's this stock. I had put in a lot of money. In 2008, we had thanks to the market made some money. And I said now that's it. Ho gayi zindagi. Like I'm sorted. Like this is my
Yeah.
stock for life,
Hmm.
right? And if I had not had the discipline of stop loss, you know where I would be. So it's you may have sold some Bajaj Finance early. That's fair enough. But also thankfully you sold Suzlon on time.
Yeah, I mean, if you've avoided the major time bombs, then I think even if
Yeah.
you've missed a few gems, that's fine in life.
And
Yeah.
it's going to happen. It's going to happen.
You can't get all of them right all the time.
This is no
Yeah.
perfect. The whole thing. This journey is all emotion.
Yeah.
It's all emotion. I mean, look at the markets right now. Yeah, they are testing us. The last 4 to 5 months have been so testing. It's unbelievable. Yeah.
it is.
It's like you're standing in a street and you wonder why are all the cars somewhere else. Like you're so alone because every day you wonder. Yeah, because we are all growth investors. That's what's happened for the last bloody 40 years. Yeah. For 40 years, it's been about growth. We are all growth investors. We are in leadership. Our stocks have done well. And suddenly, what set of stocks are moving? Are stocks which we would not have, we've seen them around. I haven't bought them for 10 years, 20 years.
So before we go into the break, and since you mentioned Titan and Rakesh Bhai, there's one thing that people probably don't get about him very often because he, maybe they don't know him obviously as
Sure.
as well as you do as someone who's worked with him. I probably met him a couple of times in my
Sure.
old thing, but there are a couple of things people don't get about him is the way that he handles emotions.
Yeah.
Because this is a guy
Yeah.
who figured Titan before the market,
Yeah,
figured Lupin before the market,
absolutely.
figured a lot of stuff before the market and wrote them all out.
Absolutely.
At the same time, he's obviously also had some mistakes.
Yeah.
Before we go into the break, just tell me about what it was like to work with him and whatever stuff you learned.
No, I mean, he's a great guy. The beauty about working for him is that he's a person who's a trader, investor, and a private equity investor. So I always feel that Rakesh ji has a 3x brains because not only does he trade very well, which itself requires all your brain power, and still most people fail. He's a great investor, and he's also very, very active and successful in private equity, which very few people know about. So first and foremost is that here's a person who is a little outside that bell-shaped curve. He's somebody with supreme intellect. And people very often, like they see him on TV, etc. And, he's got a
He's-
jovial nature.
Yeah.
They don't realize, but behind that is a very, very sharp brain. So that is something that comes across. He's special. Let me honestly tell you.
Yeah.
Intellectually, it's like when you were in school and one kid came first, and whatever you did, how many tuitions you went for, how many revisions you did, that kid always came first. So he's somebody who's just blessed with that kind of intellect. And for me, working with him was great because he's also someone who's seen the ups and downs. He's also seen ups and downs, and that is why he gave you that space. There are a lot of guys who can't take losses. When you manage money for people, they can't take losses. For any loss, they figure out, they cross-question you, they second-guess you. But in the time that I managed money for him, not once, and I can say that hand on heart, not once did he ask me why I did what I did.
Wow.
And that is something, that is why I call him as a great influence, mentor. And he helped me. He didn't help me, but he let me learn on my own terms and develop my own style.
Yeah, Bollywood's got a word for that, right? Jigra. I believe that's what they call it.
Absolutely,
He's
absolutely.
just so good
He's
at that.
unbelievable. Yeah.
Folks, on that note, believe me, guys, I think we can go on talking about markets and veterans in the market for
Absolutely.
as much as we want. But we'll take a small break now. On the other side, we're going to talk about how the markets are playing out, how they played out, how trend investing, works in this, and of course, what lies ahead. Don't go anywhere. We'll be right back.
Hello, it's been another great week on the IVM Podcasts Network. On The Habit Coach, Dr. Richa and Ashton talk about the ill effects of cigarettes, vapes, and hookahs. On Misconduct, Raghavi and Nisha introduce us to Sarlaben, the woman who led the Chipko movement. On Naan Curry, Sadaf and Archit talk about the tearjerker of all vegetables, onions. On Pulyabazi, Pranay and Saurabh analyze whether Indian states should engage in economic diplomacy. And on Ek Chuski Finance, Priyanka tells us all there is to know about KYC. We've got some exciting news for you. IVM Podcasts has just launched its merch, and our first line is out now. Head to the IVM Podcasts website and click on the shop tab to check out our first collection of t-shirts. Do follow us on social media. We are IVM Podcasts on Twitter, Facebook, Instagram, and LinkedIn. And remember, if you're enjoying this show or any of our other shows for that matter, please do tell a friend. Also, don't forget to rate us on any platform you're listening on. And you can also check us out on YouTube. We're also doing a small listener survey to better understand how you respond to our shows and advertising on the network. We would really appreciate it if you could spare a few minutes to fill it out. It helps us build better shows for you. And finally, we would like to thank our sponsors this week: SBI Life Insurance, Jupiter, a digital banking app, Cap Gemini, get the future you want, Intel V Pro, built for business, and Intel, future banao wonderful with Intel powered laptops.
Atul, let's talk about at the index level, okay? Because I know that I've seen your YouTube videos and you've got this very clear and very simple way of understanding the phases of
Right.
what happens after you've had a major crash.
Correct.
Whether it is post IT, whether it is post Lehman, right? Let's talk about that at a phase level, how trend investing plays out.
So again, through experience, I've learned, Anupam, that there are three stages to a bull market, and more so these play out after a crash. Crash is always a reset moment. So when we went back and we did this work internally, I would say about 6 months ago. The markets were running away 18,000, and people asking, now what? First and foremost was we were very clear that this would not replicate itself in the year ahead. Year end, people like to see what's the year ahead. So by November we were doing this work, and first it was very clear to us that this thing cannot go on. Yes, it can get extended, but not to extrapolate and think that, oh, this is going to be returns for next year. First and foremost, let's not missell to clients. First and foremost. Second is that we decided to go back in time and see what happens when markets crash. So 2000 was one such time. You had the whole IT crash, 40% or so the index came, but I think a lot of IT stocks fell 90%. And I think it from 2000 till 2003 mid, it was almost about 2.5 years. The market did nothing. It was painful, very, very painful. And in 2003, suddenly the market just took off. Right, and the market just I think went 120% from mid 2003 to mid 2004, and people were caught napping. It was the sweetest phase of the market. Then the market, we had a fall in 2004. There was a political change. I think it was UPA 1 that came in, and the market cracked down. We had circuit cases, and then it took all of 2004 to recover. It took it almost another year or so of no returns. And then it is only after 2005 or so that we really saw the secular bull market to 2008.
Hardly 3 years. Yeah.
So when we talk of the market, we say 2003 to 2008 bull market.
Like it was one continuous.
Correct.
Wow.
But interesting, there were 3 legs to it. So the first leg, which happened from 2003 to 2004 mid, which was about a 120% return, plus or minus some percentage, it's nothing but like a spring that's compressed. When the markets fall, excesses get done on the downside, and it's a spring that compresses. And that spring gets released, it is very fast and sharp. Very fast and sharp. Most people are caught napping. They have owning the leaders of the last bull market, and the most oversold stocks actually bounce back very sharply. So this is something which we again saw post-COVID, that the market took everyone by surprise. We went up, I think, 140% or so. And 16-18 months there. So, but the stocks that led were actually not the leaders of the previous bull market. A new set of beaten down stocks or small caps. Nobody wanted to touch small caps from 2018. Small cap funds were down 60-70%. But that is what led the bull market. So the first phase we realized in 2003 to 2000 mid 4 was the spring action, what I term as the oversold rally. The same thing happened in 2008. We had the financial market crisis, Lehman crisis. 2009 was a spectacular year. I think 160% or so returns. Same spring action, compressed spring, just whoop, takes off. And everyone's caught napping. It's almost vertical. But then what happened was post 2009, the market went into almost a 3-year kind of consolidation. And we had zero index returns for 3 years. So that is what happens, is that markets have the first phase of an oversold rally, then they consolidate. And that is where we are today. What we think that has happened to the market, we topped out in, I think, October of 2021, 18,600 or thereabouts. And, we feel that the market is meandering. This is nothing but a consolidation. I know it feels like a bear market. People have given back a lot of gains, but actually this is a larger consolidation, and I feel this consolidation would play between 18,000 to 15,000. Of course, that's 3,000 points. That's about 15-17% at an index level. But then that is the nature of ranges. These are very, very painful times because you're just getting squeezed and squeezed and squeezed. However, these are not also times when you should give up on the market. People will get frustrated and give up, because here are sown the seeds of the third phase. Just as in the 2004 kind of move, it was then that the whole move to 2005 to 2008 happened, which was very glorious. That is when the maximum money was made. Similarly, post 2009, the bull market happened. It went sideways, and then you had the big phase. So in this phase of consolidation, the seeds are sown, and that is where leadership changes. Because as I said, the first phase is the most beaten down stocks. But what will emerge now in this phase is companies which have sustainable earnings, which has very good strong trends, and these trends then tend to be very elongated and probably the most rewarding.
So before we go into that final part about stuff that you like, I just want to talk a little bit more in depth about what's happened, post, let's say, COVID, because we were at 12,000 Nifty from 12,000 pre-COVID, I'm saying. Okay. By the end of 2019, early 2020, we were at about 12,000, 12.5 on the Nifty. We had a nice sharp 40% dip. We went all the way to about 7.5 and all. 7.5 then to 15 was just like one major, probably first from 7.5 to 12, that is regaining the old
high
top, making a new top, which is 15. And then you had that massive 15 to 18 which just zoomed off.
Absolutely.
So where do you think we are right now? Let's talk about, that. From 18, I think we are down again to about 16.2.
So as I said, the typical play out was like that spring, and that took us to 18. Then the markets go into consolidation. Now, honestly, Anupam, it's very difficult for me to tell you what the time zone is going to be. It's going to be 6 months,
could
9
be anything.
months. It could be anything. But what it happens, it has all the traits of that squeeze. It is very painful. It is very excruciating. Energy sapping, as I would say. People are and I see it. I talk to investors and things like that. But also, what I do is I leave an eye out and see that where is the new leadership emerging. Because even in this sideways market, there will be sectors and themes that will continue making new highs. And that is what I would really like to look at and bet at. Because they will be in the unloved, under-researched and under-owned sectors.
It's going to play out again, huh? Let's just get into that and wind up the episode. What do you think is looking good?
This is going to change. It's not really something that has... let's take defense sector. Okay. When I tell people defense, they say, crap. Any government, first of all, PSUs are the most hated place. Nobody wants to own a PSU. They said, this, etc., etc., etc. I'm not saying it's going to be the next big theme, but hey, it's interesting. I'm not that I'm invested in them, but I'm looking at it. It's very interesting. I feel some of the infra stocks are doing very, very well. They're coming out with very good numbers. And even in this market where we're experiencing pain across the board, some of them are pushing to lifetime highs. So again, it's an underloved, underowned sector. Most overowned in 2008, then it was all dumped, thumped, exited, never to touch again, chore companies, whatever we termed it. But there are some interesting stuff happening. Again, I'm not saying that these are going to be leaders.
Who knows?
But these are themes that, I am looking at. It's interesting. Let us see if follow-ups happen. So I feel that, PSUs, That's another very interesting theme. Of course, these defense companies are a subset of that. But I feel that there are some themes that are playing out. I am not very gung-ho on. I mean, I think the biggest question right now is inflation. I mean, if you permit me to talk on
Please,
that.
yeah, please go
Because
for it.
like the whole world thinks that it's inflation, etc., and U.S. bond yields, which is really what the central point is. But I'm one of those little contrarian in my thought process. I personally think that yes, what had happened was that you have a secular downtrend of 40 years in U.S. bonds, which were 12, 13, 14%, I think, and then came down. However, when COVID struck, the Fed went very aggressive. And in this whole downward channel, the lower channel broke off. The bottom of that market came off. It went to 0.5, 0.52 or something
Massive
like that.
bond rally, yeah.
Massive bond rally. And then post we realized that okay, things are not so bad. It has sprung back. What has happened to bond yields is nothing but they have come back to the channel. And they have come to the upper end of the channel. So from the base, it looks like a very big bond rally. But if you look at from the highs, it is still in the longer term trend. Of course, I would be worried if bond yields go beyond 3.25 to 3.5. And mind you, it's just below that. So it's a very critical point. I'm looking at it with concern. But I personally think that they are not going to be that kind of, takeoff. I'm already seeing that in metals. If you look at commodities, you'll find that a lot of globally metals are giving away. The only area of concern for me is crude, because thanks to Russia, it wouldn't have been such a problem, but thanks to this whole Ukraine issue, that crude continues to hold very strong. OPEC also is really having a party, so they are not really helping, or they wouldn't like crude to cool off. But if you ask me, the thing that I'm looking off this whole inflation thing is that I personally think that the day crude cracks, and for me 100 is a very good level to look at, I feel that this whole inflation talk will be out of the window, and the market will again, move away from that kind of thing where you are saying that you want to go into only value stocks and growth is crap. Of course, I could be biased because I'm a growth investor and I'm going through a lot of pain right now. But I personally look at it with great interest. I'm looking, I believe that post-June, we've been talking about inflation. It's going to be till June, but post-June, people are going to look back at growth because they're going to be surprised that actually growth is going to be the issue and inflation may not be such a big issue.
That doesn't sound too good. When you're saying growth is going to be the issue,
growth is going to be an issue because then
dicey.
you will have to again go back and this whole tightening, 50 bips and 450 bips and 75 bips, etc., are going to be arguments which are going to be out of the window. And then suddenly, I think by the end of the year, people are going to talk about rate cuts again.
Wow.
So, I mean, this is absolutely out of the box. Nobody would agree with me. But from what I read or what I am seeing on the charts, that inflation is going to be an issue first half of the year. Second half of the year, it's going to be about growth.
Yeah, so we've had 6 months off in the market.
Absolutely.
Like from October till now, kuch nahi hua hai. People are still, at the margin, they're still, believers.
Yeah.
Flows are coming in. SIPs are going on.
Sure.
It's not like that 2003 feeling. You know what the 2003 feeling was?
Absolutely.
Disillusionment, absolute disillusionment with equities. It's not happened so far as yet.
Yeah.
Do you think the next 6 months,
Right.
okay, that could happen? This again, the market will go nowhere. People will probably lose their faith or some stuff like that, and that's that might be actually a good point for people to look at equities. Or do you think that anything else here that
No, I can already see it. I have a lot of friends who got into the market and who were telling me, like, in fact, just one of them, he said, see, I put so much. I have these 12 stocks. 11 are negative. There's just one of them that's doing well, and that's taking care of all 11. It's just one of our Adani stock. So obviously he got in pretty early, and that's made a lot of money. But in a portfolio where one stock is holding out the other 11 is not a very pretty picture. So I asked him, yaar, why don't you add these stocks? The other 11 thoda average kar lo, ye kar lo. Pagal hai kya? Like, there's no thought about it. So these are signs, and you're seeing that in the US also. Like I was reading some of Morgan Stanley report that all people who came into this whole meme stocks and the Robinhood kind of things, that they're already out of money through some
big time,
through some statistical analysis. Even Bitcoin for that matter, a lot of people are underwater. Probably it's 40%. That's the number I heard. So what will happen is that these things are happening, and but I feel that the whole SIP thing is a little different. It's more I think till your fixed deposit rates don't shoot up. Because as investors in India, financial investors, there are no alternative. See, real estate does not give you returns. There is a big transaction hassle. The transaction size is too big. It's not for an average Indian middle class or even for a rich Indian to be buying and selling real estate. You don't transact crores of rupees so often. I think as far as your fixed income goes, again, nothing much has been happening. And with interest rates looking where they are, I think the returns there are not impressive at all. Fixed deposits is the most favorite, most loved kind of play. But post-tax, of course, the rates are slightly higher, but, people are enjoying the equity thing. They have made good money. So I feel that the bigger story is the whole SIP cult, because I think that is more sustainable. That will kind of hold out. A lot of the retail, what we call the Robin Hood plays, I feel that they are already not looking at the screen. They're back to work. A lot of people's dream of sitting at home or sitting in Goa on the beach and trading.
Ho gaya.
Wo ho gaya.
Yeah.
Wo ho gaya.
You still think that this could be that the market itself is taking a year off and chilling out somewhere, right? I mean, if you look at 2004, like you said, this could be a year. But
absolutely,
longer term, you think the broad trend is still there?
I think so.
You're a believer in that?
I personally think so. And I feel that, if you ask me to go back in history and look at time and what sort of sectors and themes, obviously they don't play out the same, but it would be more like 2004 or so, where it would take some time and then it would take off, and then we would, because I think that it would be more, revival-led, because again, I spoke about infra stocks, I spoke about such themes. These are really when you really have an economic revival. And I think if we revive our economy, it will going to set up new set of leaderships. And those tend to be more sustainable, because it's not about driven thanks to just infuse with liquidity and things like that. If the fundamentals play out, earnings play out, managements play out, I think a lot has happened in corporate India. I think we've really evolved as a country. And fingers crossed, taking pain in the short run for sure. But I guess that's what market's all about.
On that very optimistic note, that is a wrap on this episode of Paisa Vaisa. My guest, Atul Suri, CEO, Marathon Trends. Atul, thank you. Thank you so much for dropping by to the studio. Hope to have you again. Thank you so much.
Thanks guys. Bye.
And listeners, thank you for listening to this episode of Paisa Vaisa. If you like this podcast, don't forget to check out other interesting podcasts on the IBM network. You can listen to us on the IBM Podcast app or ibmpodcast.com. You can also follow us on our social media. We are IBM Podcast on Twitter and Instagram. And if you want to reach out to me, I'm your host, Anupam Gupta, B50 on Twitter. And folks, thank you so much for listening to Paisa Vaisa.
No material on the show should be considered as financial advice. The material on the show is for informational purposes only. Please consult a financial advisor before taking any investment decision.